Welcome to Beyond the Sign, powered by the Sears Group at West USA Realty. I'm Landon Ball alongside my co-host, Martin Sears. Each episode, we pull back the curtain on the business of living, from real estate and finance to the people shaping our communities. Real conversations, real professionals, and real value. This is Beyond the Sign. All right, jumping right in today, episode 2 of the Beyond the Sign show. We're here with Glenn Michaels, mortgage broker with Barrett Financial. He's been in the lending business for 26 years. He was telling us he's actually a meteorologist and a TV guy as well. So anyway, he's a man of many hats. But Glenn really changed the way that I think about mortgages. And something about Glenn is we're not going to be here today chatting about FHA and conventional loans. We're going to get outside the box, beyond the sign, as we like to say, and really tell you about something that so many people haven't heard of. And when you were telling us about it, you connected with Martin, amongst a series of calls, and we jumped on that Zoom, and I just couldn't believe how in the world have I never heard of this. And I kind of heard of the concept of some of the things we're going to get into. But anyway, welcome to the show. Super excited to have you. Been looking forward to this one.
Well, thank you so much for having me. The first thing I want to do is share with the public, honestly, what people don't know, honestly, is hurting them. And one is finding true professionals in the real estate industry. So everybody always talks about the 80-20 rule, right? I think in real estate, it's actually a 90-10. And in reality, I think it's the top 3% who make up the business. So when I first met Martin, I can tell you, there's not many people that I just instantly find a connection with. But that was you, Martin.
Thank
honestly.
you. I appreciate that.
Yeah.
Likewise.
And what I heard coming out of your mouth was that it was all about the client. It's not about you, right? So the reason I love this product that we're going to talk about today and am so excited to talk about it is because it literally isn't about me. It's about something I think everybody in America needs. And you heard that immediately. Mm-hmm. And so that took the onus off of your back and went, I need to learn this. And not only that, I need my team to learn that. So it really, I can't even thank you enough, because that told me what a professional you are. Because I know even if you were to give someone who did a loan with one of your other loan officers, if you were asking me to put them into this product and not give it back to that loan officer, it has nothing to do with anything but the client. Because this is going to change the life of people. I call it the game-changing home loan.
It really is. When I first heard about it, it's debt-free, right? It's how fast can you get your home paid off? Your house is one of the largest assets that we have. The sooner you pay off that asset, the better you're going to be able to sleep at night. Your money can work for you. You can do other things with that money, invest in more real estate, stock market, whatever, build your nest egg. This is fantastic, and I hope that everybody gets as thrilled about it as I am.
Yeah, this is really awesome. I've been looking forward to just chatting with you about this, because, when I'm pitching this to clients, like, I get pumped up about it myself, because I've seen the simulator and I've seen all this actually at work and seeing how that can really change someone's life. Just like you said, the game-changing home loan. But before we get into it and discussing the product, the all-in-one loan, I don't know if we've mentioned it yet, but that's what we're going to be talking about today. But before we dive into that, as we were talking this week, you had mentioned multiple times the difference and how important it was to understand the difference between a mortgage broker and a mortgage banker. You yourself, you're a mortgage broker, so I wanted to let you go ahead and establish that for our listeners so that they could understand the difference between those two, because that's really going to establish what we going to talk about today with the all-in-one loan.
No, that's actually an incredible question, because the general public doesn't know. In my industry, 75% of all lenders out there who are doing mortgages are in the category of either a financial institution like a Wells Fargo, a Chase, someone like that. And then the biggest majority are mortgage bankers, right? That means that they're getting a line of credit from like Chase or someone like that to close those loans. Well, I'm actually both, okay? But our biggest percentage as a broker, there's only 25% of us who are actual brokers. So what is a broker? A broker is not the actual lender. All the lenders come to us. Well, one of the biggest benefits I have at Barrett Financial is we are the largest volume broker in the country. In the country. That is a big thing. You know why? Because that means every lender, including the Chases, want to come to us to sell their products. So we have the gamut, everyone trying to do business with us. So I've actually, you probably don't even know this, but at one point I worked for a mortgage banker as a vice president. My job was to bring loans in and to manage, right, that product. Okay. And to get those loans out and sold. Okay. One of the benefits here that I found being a broker over years it's actually almost 26 years in January. It's coming up on. You can't compete. A mortgage banker cannot compete with a broker. Why? Because we don't have the overhead. So mortgage bankers always make that statement that, hey, if you come with us, we have in-house underwriting, we have all this. Well, guess what? I get rated with like the top lender in the country is United Wholesale Mortgage. They're the biggest by far. And I'm not trying to sell them or push them because I find rates wherever they are best. But bottom line is they rank us against each other. And if I do my business super fast, just the way it's timely from start to finish, I get ranked on that. Well, guess what? I get underwriting most of the time in the same day, worst case one day. Okay. Now, those are stereotypical loans, your FHA, your conventional, your VA loans, which we're not here to talk about. Now, one of the things that you mentioned a little earlier, what makes this so unique, this loan, like Martin, the first time you heard it, you were like, oh my gosh, people don't get that right away, by the way. You got it and you were like, oh my goodness, this is huge. Mm-hmm. My team needs to learn this product. Well, here's the thing. This product is so unique. Only one lender in the country has it. And here's the benefit. Everybody, in reality, they want to pay off their loan. Who doesn't? And if you don't, you're not thinking straight, right? You should be going, I want to have no debt. So like you said, great statement. You can use your money towards something else. Now, does everybody want a tax deduction? Sure. But if you don't have to pay an interest for 30 years or 15 years or 10, whatever that time frame is, get rid of it.
Sure. And Lynn, before we get too far ahead, I want to brief the listeners on what this is. So can you brief us on what is the all-in-one loan and what is that going to do for you as a homeowner or a buyer in the market?
Right. The benefit. What is the benefit? The biggest benefit is this loan pays off interest. It literally gets rid of interest faster than anything else. So what do you call this? It's actually called a principal first loan. All other mortgages, 30-year, 15, 10s, everything out there is actually interest first. This is principal first. Because it's principal first, it's driving down the principal faster than any other loan.
May I ask a question?
Yeah.
So with the principal first loan, it's not built for everybody, right? It's not built for the ma pa who maybe perhaps gets paid every 2 weeks, works on a budget, so on and so forth. However, if you get, and maybe I'm wrong, maybe you can correct me on the details on this. Just like conventional or FHA is not for everyone, but this principal interest only, if you've got a large amount of money coming in, like if you're an LLC or if you have a large amount of money coming in, but a lot going out, you're going to take that top number and you're going to pay that principal off. And then I'll still have that same amount of money to pay car, other assets, other bills, whatever the case may be. So that's probably for the listeners. That's probably, and you can explain it better than I can, but that's really what that is. Rather than going off of a debt to income ratio, saying, well, your housing ratio is 40% or 30%, this is like taking that top number. Can you explain that to our listeners a little bit better?
Yeah.
Or am I throwing in too much jazz?
Well, there's a lot of jazz. That's a very loaded question. Yeah. So I do want to back up with what you first said. Is this made for everybody? Absolutely not. Is it made for like a W-2 person who gets paid every week or 2 weeks? It actually can be, right? So here's really the simplest parameters. Good, if you make good to great income. Okay. Now, most people, when they first hear this, they go, oh, that's not me. I don't make great income. Why? Because that's the last thing they heard. Good works very well. Okay. So what does that really mean? You hit on a couple things that you were right on with. This is made, there are debt to income ratios on this. Okay. But it's not made for someone who's living paycheck to paycheck. This is not that person. It's the residual after your budget. So here's one thing I know about a budget and wealth. If you want to establish wealth, what do you need? A budget. If you don't have a budget, you don't know how much is left over, how much you can put into savings, how much you can invest into another area. Like you said, how many people really should own an investment property?
Everyone.
They should.
1000%.
That should be part of your portfolio. Also stocks, not 100. At one point in my life, all my investment was into real estate. Guess what 2007 did?
Mm-hmm.
Took my shorts off, right?
Right.
It was not good. But there is nothing better. If you want to read any book in the country, any book ever published on how to become a millionaire, real estate.
Oh, yeah.
It's the best. So back to your question. Should you have a budget? Absolutely. If you don't have a budget, I already tell you, this is not a loan for you. But if you have residual left over, what does that mean? That means you have excess money above your budget, because we haven't gotten into how this loan, I know you're dying to ask me some questions about that. Okay. But if you have extra money left over, that's what drives this loan down fast, super fast. And people start going, oh, well, now our money is tied into it. Okay. Into the home. So here's a standard 30-year amortized loan. And I'm going to ask you guys the question. Let's just say your monthly payment was $3,000 a month, and you made $5,000 net after your budget. So everything was paid. Your utilities were paid. Everything in your budget was paid. And the last thing was your mortgage. Okay. And it was $3,000. After that, you still have $2,000 left over or more.
Mm-hmm.
Okay. And more the merrier. Okay. If you put it in that extra $2,000 every single month into your mortgage, what happens to it? Do you know?
There was an equation I remember. If you make one extra house payment a year, it takes the 30-year term down to 22 and a half, something like that.
That's correct.
All
that
right.
actually is really close.
But if you took, for example, if your PITI was $3,000, and I'm just taking a guess at this, by the way.
Yes.
If you took $2,000 towards that $3,000, it's going to go towards interest.
Okay. It is coming off the back end. So let's just say this is a 30-year loan. Okay. And you're paying it down every month this way, going down till zero, till you have 0 months left, 360 months, right? That's 30 years. That interest is coming off the back end going this way, and they're going to meet in the middle. So it's a long ways off. So does your payment change if you pay extra on your mortgage? It doesn't, right? Also, what happens to that $2,000 that you paid into it? It's stuck. Can you touch it? No. Here's part of the problem. People are into this loan for, say, a 30-year loan or a 15 for, let's say, 3 years. Okay. And all of a sudden, something happens in life. Life is a challenge, right? It's a roller coaster. We never know. You could lose your job. You could have a health issue. You could have a family member who's in dire straits and you got to give them some money. Now, all of a sudden, you've been tying all that money into your home. A home just sits there until you go to sell it, right? That's when you finally pull the equity out. But now you need that equity. Can you pull it? Not without refinancing and do a cash out refinance. And there's a cost to doing a cash out refinance versus a normal refinance. Okay. Versus this loan, guess what? You can write a check out of it anytime you want. We're going to get into that, right? But that is a game-changing home. This is what changes people's lives because you have availability. So we're going to talk a little bit. I know you have some questions associated with that, but bottom line is this is not only the best loan for everyone who has 20% equity or more. If you have less, I hope you get there someday because this is what you got to get into.
Mm-hmm.
So homeowners think a 30-year mortgage is the default, really. So why is this so rare? Why are you the only mortgage broker I've heard, offering this as loans? Why is that?
Okay, well, that's actually two questions in one. And you know what? They're both great questions. First off, why is it the default? Because that's what we've been taught. That's what our parents did. All we do is follow suit. So
Now they're throwing 50-year mortgages out there.
yeah, I've never even sold a 40. And now we want to sell a 50 and extend that interest. Who is the winner at the end of the game? Right? The banks always win. So sadly, these things get made to make the banks more money. Why? Because the Federal Reserve actually is a conglomerate of all banks together, all FDIC banks. That's where the money comes for Federal Reserve, that they can write a free check. Do they want them to make money? Yeah, it gives them more money to spend. Okay? So I don't want to get off on that too much, but here's the thing. Great question. There are so few of us selling this loan. I don't know what that percentage is, but I'm guessing I'm probably less than 1/8 of our percent in the country who are even qualified to sell it. So what does that mean? Number one, all the mortgage bankers that we were talking about and financial institutions, they can't sell this loan. There went 75% of them. The other 25% that are brokers, only the bigger banks, bigger brokers are even allowed to do it. If you're a small broker, unless you've already established yourself, you cannot sell this loan. Then you have to get trained on how to sell it because it is out of the box. So that's what your question really was, right? It's so out of the box, a different mindset that I need to train people how to actually understand it. Once they get it, they're like, oh my gosh, this is a no-brainer. It really, really is. It's that life-changing. And I've been selling this since it came in inception into the U.S. This has been around for years. Do you know 40% of all Australians have this loan? It's been around for years. They also have it a few places in Europe. It's been around way before the U.S. got it. One company took the risk in 2005. Guess who the first loan officer who got trained to do it?
That guy.
Yours truly. And guess who my first client was? My dad. He was an engineer. He loved numbers. And when I explained it to him, he goes, wow, Glenn, this is way too good to be true. Way too good to be true, which I hear all the time, by the way.
Yeah, that leads me to really my next question, and that'll kind of take us into how this actually works. Is there's a lot of folks that say this sounds too good to be true. So what's the actual math behind it and why it works?
Okay. One thing we know is math never lies. It always tells the truth.
That's Martin's favorite go-to.
That's right.
Really?
People lie, numbers don't.
I say that all the time. Thank you very much. I knew we got along. Yeah. Right? So that is so true. And here's the thing. I had to get trained on a simulator that this company designed. This software is unbelievable. And here's what's great. When I get through with a client and showing them all the details, because there's tons of different things. So what's the basis of it? Number one, I can do a purchase on this. I can do a refinance for primary, secondary homes, and investment homes, all three. And the secondary and investment with normal loans, Fannie Mae and Freddie Mac, guess what? All conventional loans, all loans, FHA loans, VA, they're all government loans. They back them up, every one of them. This is a private sector. Okay, this is one company who sells this product to specific banks because the banks, why do the banks love it? There's never been a foreclosure on this product in 20 years, almost 26.
Isn't that fascinating?
Yeah, that is.
How is that possible? Because it takes the right client. Going back to what you said, Martin, right? It takes the right, it's not for everybody, but I can tell you lots of people have good income. Lots of people have great income, and every one of those, like as an example, someone who's buying a house that's $800,000 or higher into the millions, okay, I can go up to $3 million on this loan. I mean, I literally did a $2.6 million loan recently, and because his income, like you said, he owns Chick-fil-A's, okay?
I remember you telling me this story.
Yeah, guess what? He's going to have this loan paid off in 5.7 years.
Yeah, that's what you were saying, like 4+ years.
When I met him at his house.
He turned you on to all his buddies.
Yes.
That also own Starbucks and Chick-fil-A's and all that. So.
And he was so giddy when I was showing, he got it because he's a business guy, right? And the light bulb went off and I saw it in his face. He's like, how fast can I do this? I want to close right away. Guess what? The simulator showed him, this is always worst case scenario on the simulator, by the way. That $2.6 million loan will be paid off in 5.7. More importantly, how much interest did he save versus the 30-year loan that he had been put into by another lender, okay? it's going to save him $1.98 million, almost $2 million in interest. Is that a big number?
It's unbelievable.
That's
Right?
generational wealth.
Yeah,
right
it's
there.
life changing. I mean, when you do that, if you save someone that much money, I mean, you're really changing their life. And I remember when we played with the simulator, when you get into the $1 million homes, I mean, it's a no-brainer.
Why is it a no-brainer?
Because the amount of money and the amount of time that they were saving, I mean, we were talking.
It's huge.
I don't remember the exact number.
Well, the
but
amortization,
the
sure.
amount of money was just insane. And just comparing that, especially to where some of those people would fall into the jumbo loan category, and that rate's even higher.
Yeah. So any loan really over like 850 is going to go into the jumbo. And here's what we know about anybody who gets into that type of product, even in loans that are 600 and above. Every single one of those people, what do they have that most don't? Great income. Because they don't want, I mean, every time I talk to somebody who wants to do this loan and they're in the millions, their income is always spectacular.
Mm-hmm.
Like the gentleman I just told you about, he had a $20,000 mortgage payment. It was just over that. He didn't even flinch. And I'm thinking, $20,000 a month
Mm-hmm.
on a mortgage? Who wants that? Nobody.
Yeah. And I want to dive into what it looks like, what this loan looks like as it becomes your checking account, essentially, right? And I want you to dive into that because I think that ultimately is what clicks for people.
No.
Is when they realize
I
that,
agree.
okay, I see how that's taken those years off, because they hear the principal first and they hear that I can pay my house off in 6 years instead of 30, and they hear these things and it sounds great, but where I've had a hard time connecting the dots with people is where you tell them that it becomes your bank account, right? Explain that to us.
Landon, you actually just hit this on the head, because every single time I get into this, people ask me the same stuff.
I wish we had a simulator that we could show.
Right?
And I think we talked about
That'll have to be another one.
Yeah,
to
totally.
dive into what you do after you get this loan, right? Because that's really when it becomes its full force, is once you have it. And we'll get into that with the investment purposes and second homes. Right?
I know we're freestyling this, but it would be awesome to have our audience, I don't know, send an email, send a private message to get that simulator from Glenn.
Yeah.
Because we can talk about it, but until you review, and I played with it before.
Yes.
And it's fascinating. You plug in the top number, and then you just kind of do what you think you're going to have with that residual, and all of a sudden you
based
see that
on your
30
budget.
Based on your budget, and you see that 30 years, and I won't take away your steam here, but it just goes down by 2/3.
Yeah. Well, if you would like a copy of that simulator, we can share that out, right?
Yeah, here's what I would say though. Here is the problem. Because normally what I do with people is as soon as I talk to them, I go, okay, I want you to really look at this. And when I send, I will not let anybody do this loan unless they watch a video that I have first.
Mm-hmm.
It's about a 28-minute video. So is 28 minutes enough time in your life to change your life?
Mm-hmm.
This is literally game-changing, right? That's why I call it that, the game-changing home loan. If you don't have 28 minutes to change your life, to build an inheritance for your kids, because that's what this can do. It can do that, okay? Now, here's the problem. Even people that I kind of coach a little bit, the first time they watch me on a Zoom call do the simulator, all they can do is make one mistake and it changes the results, okay? So giving it out to everybody, hey, if they want to look at it, great. But in essence, they really need to sit down with me and have me go over, or one of my team people to go over it, right? Because the end result is you want to see the results. How fast is this going to pay off versus my 30-year loan? Now, I know we want to talk about this later, but I had a client, this guy, what he does for his living, okay, he does benefits for large companies. We're talking their health insurance, the 401ks, they do all of that stuff. So does he understand money?
Mm-hmm.
Totally. Guess what? Great friend of mine, I've known him for 20 plus years. He had a 2.875 loan. And he called me and said, Glenn, I know you tried to push me into this loan years ago and I should have done it, but I've had this 2.875 now for 5 years. It's a great loan. And would it make sense for me to get rid of it? To be honest, I said, his name is Dave. And I said, Dave, I think that's probably a mistake. I don't think this is going to work, because by the time we ran the numbers, guess what the results said? because there's all these different tabs. And when I teach people how to use these tabs, it goes back into something you said later. What do you do with it after it's paid off? So when we compared his 30-year at 2.875%, okay, that he'd be giving up versus going into this, and that rate at the time was 8%, and people go, oh my gosh, that's a huge rate. This is not a rate-driven loan. That is really hard to get your head around.
Yeah, I'm glad you mentioned that. That's important to know about this.
Can I get into that in a second?
Please
totally.
do.
Yeah. Well, this particular guy, when you looked at the actual results, the results said it was going to pay it off in 13 years versus he still had 25 years to go. So he's going 13 years looks great. And I said, well, Dave, let's not jump into it yet. I understand you want it, but we've got to get a little deeper. And here's why. In the results, it said what was the actual cost? Because his rate was higher, going from 2.875 to 8, there's a cost. And that cost was actually $37,000 more doing this loan.
Mm-hmm.
And I said, Dave, I'm not sure that makes sense to me. Do you want to pay $37,000 more? Now, it gets rid of 13 years. Okay, actually 12 years, sorry, 12 years. So now we have to go to another tab. It's the investment tab. Okay, and in this investment tab, and this will be another one where we can get into that. But guess what? By him not having that mortgage now in 12 years, it's gone. Okay, he's got 13 years that he normally would have paid on that.
So
Now-
that principal is probably $2,000 a month
Yes,
times 12 months times 12 years.
144 years.
Right. That's fantastic.
Yeah.
Right, of investing into something else. This lets me put a number. Anyone, once I teach them how to use
So
this
37
thing,
or 144,000.
right. And what does every financial advisor say? Over long term, guess what? You're going to make 8%, 6 to 8%. That's the most common thing I hear. Well, I say, hey, you can put that number in, but let's even drop it down to 5 or 4 and see how much money. When I did that, guess what? He will have made $137,000 more. No, sorry, $337,000 more at 5%. So I go, okay, this is a no-brainer, Dave. And he goes, what do you mean? I go, remember it was going to cost you $37,000? Is it worth it to pay $37,000 to make in the difference when you don't have a mortgage anymore at 5%? $337
Debt-free,
debt-free.
right?
Yeah.
Compound interest. Take the residual of what you paid off on a large asset, put it into the averages of the 6 to 8%. S&P 500 is 8%.
There we go.
Bam.
Right.
I always
That's
say
one of the best
monopoly money.
indexes out there.
You know, everyone has. I talk about monopoly money a lot of times. And everyone talks about how much their house is worth, and I have this much in my house. We truly don't have anything in your house unless you have this loan, or possibly if you've opened a line of credit. But I know you call this a line of credit on steroids. So tell us that. I mean, where's the steroids at in this? Because obviously we can see it. You've talked about it, but I want you to tell our listeners, the specific steroids in this product compared to your standard line of credit.
Thank you for bringing that up, because that is an absolute incredible question. I do call it is a line of credit. It's also, you can say it's like a home equity line of credit on steroids. Well, what does that mean? Anybody could keep, like my buddy, we looked at that solution as well, going, okay, why don't you keep your 2.875 and the equity, why don't we put a second on this thing, just a normal home equity line of credit that you can get from any bank, right? Any credit union. So, but it doesn't work. It doesn't do the same thing. You would have to pay it off, take some money and pay it off. And where's it coming? Just like I explained earlier, it's coming off the back end of that loan. Can it do the same thing? Just not at the same cost.
Okay.
Okay. This one is a first position loan. So something you had said earlier about the checking account, this fits right into that question, right? Here's the steroids. Imagine your mortgage that has checking, savings, bill pay, checks, ATM, so you can use it just like a debit card. All right. So this is where it really gets exciting. This is all in your mortgage. Most people have like some security money sitting around in a money market, like $100,000. Now, I'm not telling you to take money out of the stock market. Now, We know the stock market's been going crazy since 2009. It's literally just gone up. Any financial advisor could make money. At some point, that's got to change. Okay. Would you then take money out of that and put it into this? Wouldn't be a bad idea.
Mm-mm.
And you know why? Because this is my own term. So anyone who's investing, and this could be another podcast, okay? Anyone who's investing, I call it forward investing. Why? Because you're making money moving forward. I call this term, and you won't find this online because I've had clients, I've said it, and they go, I couldn't find where you called reverse investing. This is my own term. Okay. Well, what does reverse investing mean? Okay. So imagine that your interest rate on this loan is 7%, 8%, whatever that number is. Now, if on a forward investment, moving forward, like the S&P or any stock, can your financial advisor guarantee you a rate of return of 6 or 8%?
No.
Why not?
The consumers drive the market.
Right. So it's fluctuating based on market.
Absolutely.
Right? Based on economy and what's going on
A lot
every
of other
day.
tangibles, right?
Yeah.
Politics, the market, supply and demand, tariffs.
Yeah.
There's a lot
Right.
of
Yeah.
stuff.
Right? So every day you see the market going. I mean, people who look at their stock and their 401k and they're going, wow, my 401k went up, 8% this last year, 10%. But I'm afraid what just happened yesterday, right? Because it's going like this every day, right? What if you could be guaranteed an interest rate? I can through this loan. Guaranteed. It's reverse investing. So what does that mean? Now, I'm going to try and go slow on this one, okay? And I don't want to get too deep. That will be another podcast. But imagine this. Let's just say you got an inheritance and you got $100,000, a family member passed away and gave you $100,000. And you owe $400,000 on this loan. And you went, what do I do with the money? Well, I could give it to my financial advisor who says he can get me 6 to 8%. Right now, because the market's so high, that scared me a little bit, to be honest.
Mm-hmm.
But what if you could guarantee an interest rate? Okay, let's say your interest rate on this is 8%. If you took that 100,000 and it was at 400,000 and you put that 100,000 and now it's at 3, you just went down this amount.
Mm-hmm.
Here's what's beautiful versus when you put money down on a 30-year or a 15 or a 10-year, any amortized loan, does your payment change? No. Stays the same through the whole term of that loan, all 30 years, 15 years. On this one, the payment drops based on the principal.
Mhm.
There's part of the steroids.
Yeah.
Okay.
That's neat.
So now you're paying on this 300. So that 100,000, guess what? You just didn't pay 8% on it. Did I just guarantee you reverse investing?
Indeed.
You know why? Because you didn't pay 8% on that 100,000. You just put it in your bank. Where's your bank? Your mortgage.
Mm-hmm.
You're making your mortgage the bank. Your checking account. It's the bank of you,
Right.
right? This is game changing. It really is.
It really is.
Now that extra payment, that let's just say that 100,000 was another, I don't know, let's say $800 a month, because this is based on simple interest, by the way, not amortized, simple interest. So what I got to fill that into, what's simple interest? If you had 100,000 times 8%, you multiply 100,000 times 8. Okay.
Mm-hmm.
Then you divide that by 12 months. That's how you figure out your payment for a month. It's that simple. Okay.
Chalkboard math.
Chalkboard math. Math never lies.
That's right, brother.
It never lies. Right. So now guess what? That extra 800, where's it going to? To drive down that loan even faster. When they first started this loan, guess what they called it? The acceleration loan, because it accelerates your principal. Now, if you're not excited about hearing this, there's something wrong.
No, this is fascinating. And this is a program about real estate, obviously. And one of the things that my mind is going through when you're talking about this and I'm getting passionate about, I can feel and I can totally hear the passion that you're into this thing. And I am too, by the way. Our job in this program, or just as fiduciaries, is to bring hope and to build wealth. Really, that's really what it's all about. And when you do something like this, guys, you know how average appreciation works in real estate, right? So the national average is between 4 and 6%. Those of you who are looking to buy a house right now in the Maricopa County environment, everybody knows that we have got a lot of supply out there right now, a ton of supply, which means it's in theory a buyer's market, especially here on the west side of Phoenix. It just is.
I would say everywhere.
Mostly on this side,
Yeah.
but yes, 1,000%. How long is that? That's not going to last forever. I mean, we've got 4.5 months of inventory. What happens when that inventory gets down to 2.5 months? Now it's a neutral market or it turns into a seller's market. Your appreciation is going to go up. The interest rates go down.
Supply and demand.
1,000%. You do something like a loan like this, you guys, what Glenn's not also touching on, which is our job, you're knocking down that principal, but you're building equity, right? So you're building equity and you can borrow from that equity.
In this loan, you can, not normally.
That's exactly right. You can borrow from this loan and use that money to even pay off more of your mortgage or to take that money and go do something else and buy something else.
An investment property.
Investment property, right. Money makes money, people.
That's right. I got to ask you, because I was actually talking to my father-in-law yesterday about this interview, and he asked me a question to give you, right?
Here we
So,
go.
I want to give it to you. And it kind of gets into, I think, the investment properties, and you've touched on it already once with your friend who did this. Let's say, for instance, if someone has, just 5 to 10 years left to pay on their home, and they have that low interest rate, but they're reaching that retirement time in their life, and they're looking at what can I do to build wealth for my retirement outside of what I already have, possible investment home, second home.
Mm-hmm.
Tell us about that. When you buy
Like a non-owner occupied versus an occupied house.
And when you buy a second home now, you have the same cost as an investment property. This loan becomes even more a no-brainer, in my opinion, when it comes to that. So I want to ask you that question, though, from my father-in-law, is for someone who has 5 to 10 years left to pay on their home, how does this make sense for them?
Okay. So if they still have a mortgage, correct?
That's correct.
And it's a 30-year.
Correct.
And my guess is they got a refinance probably 4 or 5 years ago.
Yeah, probably about right.
Okay. That's really where that question is. So what's his amortization? Has he been accelerating that loan?
I think they did accelerate it some. I don't know the full detail, but I do believe that they cut years off the loan.
And that only means that they've put extra money above their PITI payment. So everyone who gets a mortgage, you have an option. You can be doing this online or literally getting, what's my payment every single month, your mortgage statement.
Mm-hmm.
Okay. Now, if your payments say $2,000 a month and you're paying an extra $1,000, like we talked about earlier, it's going into the house. You can't touch it.
Yeah.
It's stuck. So how is he going to get all that equity, right? In 5 to 10 years, there's only one way.
Yeah.
He's got to sell it. You don't get equity until you sell it with a normal loan. With mine, you can write a check. So here's the beauty. If my guess is he's still got 15, 20 years at least on this loan, unless he's been paying it down big time.
I think it's less. I think it's closer to about 10.
Okay. Even 10. Is he still paying the same payment? Hasn't gone down, has it?
Nope.
So in other words, if he was refinanced into this right now, guess what? His payment's going to drop big time. And the amount of money, let's just say he kept that same budget. Say that payment was $2,000, but all of a sudden this payment's now $1,000. Where's that extra $1,000 going? Right towards his principal. It's accelerating that so fast to allow him to do what he really wants. And that is just to buy, maybe he wants a second home. Maybe he wants an investment property.
Maybe he wants to travel.
Yeah, exactly. And when if he buys that second home, how's that gonna work?
Okay. Here's the beauty. Okay. Now, in his circumstance, I would probably be forecasting myself. Okay. That's a great word, forecasting into the future. I'm thinking in 5 years, maybe 10, whatever that number is, 5, let's say 5. I want to buy a house that is, like you talked about appreciation. Mm-hmm. We have to assume it appreciates versus today. Say he wants a $400,000 house today. Let's say that house in 5 years from now is $450,000 or $500,000, just based on appreciation. So if he really wants to use this, if his house has the equity now, not just take out. Now, this is a line of credit. Remember I said that?
Yep.
Okay. If he only owes, say, 100,000 on it, but his house is worth, say, 800 or 600, whatever, take the max on this thing. Even though he's not paying on that, you can take a line of credit. Now, how do I get paid? We're going to have to talk about this a little bit too. How do I get paid on this loan? It is a costly loan. It is a costly loan. I want you to ask me that later. Okay?
Yeah.
Let's ask you right now. What is the closing cost on that?
I don't want to get off track. Save that one. I will answer that, I promise. But bottom line is, I only get paid on the amount that they actually use. So there's a loan limit and a line of credit. The loan limit will take me up. So in his case, I would tell him forecast into the future. I want to buy a house that's, say, 500. So if you want to write a check from it, guess what you do? If this house that he has now has enough equity, you push that loan line limit up to the maximum that you can. Now, the line of credit that he's going to actually borrow is a little different. He's going to be paying on this amount, but he's going to qualify at this. You know why? Because 5 years from now, when his house is paid off using this loan, it accelerated, probably even faster, to be honest. Probably be like 3 years. We'd have to run the simulator. I don't know his income, but I'm guessing it's going to pay off really fast, which will allow him to do what he wants to do much faster. There's the benefit. And because he got a line much higher at the very beginning, guess what he's going to do? He's not going to go out and get another loan, which is very costly, by the way. He's going to write a check right out of this. Literally, he's going to come to you and go, I want you to find me a house. Where's it going to be? Well, I don't know, Prescott, Payson. Excellent. And guess what? You're going to write a check for that house.
You know, it's kind of like it's a forever loan, really, and I'll just throw it out there.
Kinda.
That could be, kinda. You know, that could be the reason a lot of banks and lenders don't offer the product, right?
Absolutely. They want to make more money. Yeah.
Well, back in the day, if you think about it, just the analogy of banks and farming communities and small town banks and always use the local person, you always owe the debtor. Banks, right? The institutional banks, they're always at every chamber. They're always around. Everybody always knows a banker, so they can loan you money. That's their job. Yeah. So yes, you could have one institutional person like Barrett Financial to succeed all of your goals that you want in life, I guess.
No, it's very true. Now so that brought up something else. How does this mortgage work? And that's why I can't wait till we do another one and we can get it up on the screen. Yeah. So I can literally
Maybe we shouldn't ask you about the fees until the next one.
Well, I'm actually proud of what I do. I mean, really proud, because
we can tell you're real passionate about it.
Yeah, you know how you can tell the posture? Because I'm like this, I'm like almost hugging this microphone, right?
Yeah, gotcha.
Because I am so excited. My job, everybody's job should do what's best for the client, right? I just get paid for doing it, right? Same within real estate. When you sell a house, why do you get paid? Because you did the right thing. Mm-hmm. That's what I think every loan officer should do. Back to a question you asked earlier, Landon. It's a great question. Why isn't every loan officer selling this? Number one, they can't, okay? But the ones who know that they actually can, you know why they don't sell it? Because it is like a forever loan. That's not quite true, and I'll explain that in a bit. But bottom line is, normally, if in this market, if I was doing a loan today at, say, 6.5%, that's like the going conventional. Okay, FHA is a little less, and VA. But conventional is like 6.5 today with like 0 points, okay? I know next April, somewhere in that time, or May, when we get Jerome Powell out of there, I don't want to get into politics, but bottom line is he controls the Fed rate, which in time controls our market in mortgages. I know I'm going to refinance at 6.5 down to, say, 5.75 to 5.5. Then when the market comes down, say in 3 years to, say, 4.5, I'm going to do it again. I've made repeat business just doing a loan. I know it's going to get me paid 2 more times, at least, maybe 3. Okay? This loan, once you do this, I'm never refinancing you again.
That makes total sense. Top of mind is what we always tell everybody in the service-oriented industry. Bankers, they're going to start to think about that. Exactly what he said. This is not to throw, because we have a lot of friends and other clients and other business affiliates that are traditional bankers or other brokers. But that's right. You stay top of mind. Everybody knows there's a hedge that the rates are going to go down next year.
They are.
Most likely 50 basis points, if not 0.75, maybe more.
I think a full point.
You very well probably know more than I do.
I'm guessing.
But I'm going to say at least 50 to 75.
Yes.
Nonetheless, that's a huge difference on your payment. So those people are waiting in line to refinance you.
And guess what they're doing? Re-amortizing their loan all over again to 30 years. They're starting at day one all over again. Does that make sense?
No.
So over the next 5 years, they'll probably refinance at least 2, maybe 3 times. And every time they do it over that 5 years, they're going to start all over again at 30 year. All over. Versus mine is boom. Every time the market drops, okay, we're going to get into, is this an adjustable? Yes, it is. And a conservative one.
You know what's cool about what he just said, and my mind's going elsewhere. And
Sorry.
you take somebody who is going to refinance 2 years from now. Let's say rates are now at 4.5% in 2027.
Mm-hmm.
All right. Then all of a sudden, you got a loan in 2019. You're going to refinance in 2027. Exactly what he said. You're going to get 2 points off of your rate, but you just lost 8 years. And
That's
you're
a
starting
big
all
deal.
over. Run it through his simulator to
Yeah.
see that 8 years. What did you pay off during that 8 years? It sucks.
Yeah.
You're going to be really disappointed and really depressed.
Remember you were saying that sorry, that.
No, you're good.
If you were paying an extra amount and you save one mortgage payment a year, and you
Mhm.
dropped it to 22 and a half years,
Mhm.
which is really close, that just started all over again. You're not at 22 and a half. You're not focused on that.
Nope.
Okay.
You forgot about it unless you have a budget, unless you have a spreadsheet saying, oh, I paid you guys X. You
Now,
have to
I
do that.
don't like adjustable rates. I've never liked them. I can't stand them. And there's other things going on right now in the market, how loan officers are selling people to give them some hope, just to get the rate down and payment down so they can qualify, right? But bottom line is, with this, why has there never been a foreclosure? Because even though this is adjustable, it's the most conservative loan on the market.
That gets me into my next question, and another objection I get on this loan as well as it's safe, and I think it goes back to that it sounds too good to be true, but tell us some of the safeguards in this loan to protect the client.
Boy, you just hit one that I absolutely love. Okay. I literally did a really good friend of mine back in 2007. This is a long ways back, right? I've known this guy. He kept that loan on his house, and he wrote a check to buy another home as a primary, and he kept that one as a rental. He's actually done it 3 times.
Mm-hmm.
3 times, because he can write checks out of this. Okay. Guess what happened? He was in high management. He got laid off. This was like 5 years ago during COVID.
Mm-hmm.
Lots of people got laid off. He got laid off. And because of his position, he couldn't find another job. Everyone was getting rid of upper management. He went 3 years without making a mortgage payment. Guess how many lates he had on his mortgage?
Goose egg.
0.
Wow.
Okay, so let me explain
That's
that.
a big deal.
Yeah.
That is a big deal. Okay, so on a normal 30-year loan, let's just say you lose your job, a health issue, whatever happens in life, because it is a roller coaster for all of us. Okay, next thing you know, you got a 30-day late. As soon as your mortgage is due on the 1st, there's a 15-day grace period. That just means they're going to charge you a
Sure.
fee
A fee.
just because they can, and you're going to do it because it's built into that note that you signed. But if it gets to 30 days, even though there's 31 days in a month sometimes, right? As soon as it hits 30-day, it goes on your credit.
Mm-hmm.
Now you've got a late.
Mm-hmm.
Now, let's say you couldn't make your mortgage payment again, because when it comes down to it, who are you going to feed? Your family,
Mm-hmm.
your kids,
Mm-hmm.
right? What's the last thing? Your house. We'll find a place to live. Okay. And to be honest, what people don't even think about is they'll never take my house. It's my house. No, it's the bank's
No,
house.
it's
Yeah.
the bank's house. That's
Okay.
right.
Now it goes to 3 months and a day. Not just 3 months. On 3 months and a day, guess who sells it? The sheriff. It's a sheriff's sale. Guess who's there to buy it? All these greedy investors who are out there. And I shouldn't even say greedy, they're smart. They're out there taking advantage of what they should be. And that's owning real estate. Like every one of us, you said it earlier, we should all own real estate, and not just one house, but many. All right. That's how you build wealth.
This loan makes that realistic, though, because it's not realistic for many. I don't think, before you talk about loans like this that can save them, because most people, when they buy an investment home, there's a ton of cash buyers out there, but they're looking 10 to 15 years, as this can take that 10 to 15 years to 3 to 6. I've seen in the simulator, and I can't wait to show people that as well. Yes.
Back to that friend of mine. He never made a mortgage payment for 3 years. You know why? Because he had the equity in it. So
he had that 30-year amortization. He had down to maybe 8 years, and then took 3 years. I'm just giving examples.
Yeah. He was just literally on the 17th of every month. What this does, this takes a payment. Let me back up. Every single day, your principal, because it's principal first, it looks at each day separately from 12 a.m. to 12 p.m., a 24-hour cycle. It looks at the principal for that day. So let's imagine that you had a $400,000 loan and you got paid, you netted after taxes and insurance and whatever your boss takes out of your check, $10,000. Guess what? That month, every time you get paid, say $5,000 every 2 weeks, it's dropped $10,000. Well, every day that it's $10,000 left at $390, it's looking at the interest for $390, not $400 like a normal loan. It's looking at $390. Okay, so you hold off on making your budget as far as you can without getting any penalties.
Right.
And every day that interest adds up. And for that 30 days in the past, on the 17th of the next month, it takes the interest from all 30 days added up combined. That's what the payment is. And on the 17th, it comes out. So that buddy of mine who didn't have a job, it didn't care if he made income. He had the equity. He never had a late payment.
That's awesome.
This saved his life and saved his marriage.
Sure, of course.
Okay.
Yeah.
Why? Because finances weren't the big deal in their life because of this loan.
That's right.
Now you can get back.
Yeah. No, I appreciate you finishing that up.
No,
I'm
that was
sorry
good.
to interject.
That's a good story. Those personal stories always are the best.
Yeah.
They just are. It changes somebody. It's a life changer.
Yeah.
I mean, it just is.
I'm going to get you to start saying game changer.
Game changer. That's right.
It really is. I mean, for someone to lose their home in that situation versus not,
Right.
and not even to have a late payment through all
Yeah.
that, and to be jobless, out of a job for 3 years.
That's amazing, right?
Wow.
3 years.
God bless.
Right? Hallelujah to that.
Well, 1099 self-employed borrowers is one of the biggest fields of our clientele, and including ourselves. So I want to say, someone who's self-employed or 1099, income isn't the same every month. How does the all-in-one loan work for them?
That's actually a question for every loan officer out there, because number one, loan officers what does every loan officer want? They want easy, because my job actually is pretty hard.
Underwritten approval. EU approval. I'll run it through the system.
Right? And I'm actually certified to run an automated underwriting. So you gotta have that too. So bottom line is, when I find out what's on that approval list, if it's a W-2, I collect 2 years of W-2s. When you're talking 1099, and especially 1099 is self-employed. They're typically contracted through somebody who is their employer, and they just get paid 1099, which means they are self-employed. Now, I'm literally an expert. I have loan officers who don't like to do self-employed loans because they're literally 3 times the work. I'm really good at it. I know how to read tax returns really well. Do I get into the Schedule C and their deductions and all that stuff? Absolutely. You have to. Okay? Now, I love self-employed people for this. Now, sometimes I do get the question that I have to ask, and that is, okay, how much did you gross in receipts last year? Oh, I grossed
$1 million and my tax returns show 50 grand.
Yeah.
worse.
Yeah, worse.
Okay. I have a great story. I know an AC guy I did a loan for. He was bragging that his company brought in $2 million a year. I said, really? $2 million? That's insane. You're killing it. He goes, oh yeah. And I said, so how much of that $2 million was the cost of the AC units and employees and your building and all that? So at the end of the day, this is called adjusted gross income. At the end of the day, what does it say? 0. So you're about to tell me how proud of proud of yourself you are that you didn't have to pay any tax because it was zero, right?
Wow.
I go, do you know what that really means? You made no money. You made no money. Now, do you W-2 yourself? No, you should be. Because that's the only income you really would have. Okay. And I said, so I know you obviously made money. You wrote it off some other place. Did you make a living last year? Did you pay your mortgage payment? I did. Yeah. Okay. Did you buy groceries? I did. Did you pay all your utilities? I did. Then where'd it come from? How'd you get that deduction?
Yeah.
Guess what you're going to have to do? If you want to buy a house, you're going to go back and you're going to have to amend your taxes and you're going to have to make income.
Yep, you are.
Okay. And guess what he did? He did do that, and I ended up doing his loan.
Be a W-2 employee for about a year, and there you go.
Actually, we did it in like 6 months.
Okay. God bless.
So
That's great.
there's always a way to figure it out, right? So typically, though, a 1099 and a self-employed person are usually great for this loan. I do W-2s as well. Honestly, I do, because some W-2 people make really good incomes. Okay. And all I need is good. I don't even
Majority
need
of your paper is 1099.
Yeah, I would say self-employed. You know why? Because these people are a little out of the box. They understand budgets. They understand
They're
numbers
business
and
people.
money. Yeah, they understand money. And when they see this, when they see that simulator, the light bulb goes off very
It's
quickly.
exciting.
W-2 people don't always see it as fast, but they should and they can. Okay? Just, you got to hear some coaching. And that's what I do.
Appreciate that.
Well, I've got to ask, it was brought up, and we can dive into it more in a next episode, but why is this loan costly?
Okay. Well, that actually is a pretty loaded question too, but it's a great question. And here's why. People don't know, like, when you look at what's the average rate across the country, they say this almost every week. Okay. What's the average rate? So like right now, they'll be saying 6 1/8, 6 1/4. In reality, is that the rate? Okay. So when someone calls, say you guys are buyers and you called me and said, okay, what's the interest rate? That's such a loaded question, right? It's based on your FICO score, your loan to value. In other words, how much equity are you putting into it? 20% or 10% or 5%. All those things go into figuring out a rate. Okay. So the biggie is, though, FICO score. If you don't have a great FICO score, and I can get into that because I was a certified credit counselor back in 2007, so I could help people. So I know credit about as good as anybody you'll ever meet. All right. That's another whole topic. But bottom line is, on this particular product, when somebody calls me and they say, okay, I want like a 6% rate or 5 3/4, that's a cost. Okay. So based on their FICO, based on how much down payment they're putting in, then I start looking at rates, because every lender out there, I can go into their, let's call it simulator, right? It's their software, and it'll spit out what the actual, what we call par rate is. Par rate means there's no cost, no points, has nothing to do with title fees, closing costs, has everything to do with, am I buying that interest rate down? Okay. Am I buying it down? So the real rate is 6 1/2, say at par. But if I want 6 1/4, that might cost me 1%. We call it a point, 1% of the loan amount. If I want to buy it down, and here's the beauty about realtors, it's their job to help negotiate that deal with the seller. In a buyer's market, can you normally get a seller to pay 1 or 2 points?
All day long.
All day long in this market, right? In a seller's market, can you do it?
Absolutely not.
Not, right?
Not happening.
Because supply and demand.
Sure.
Right? Right now, there's a lot of supply, like you said. I'm glad you said that. So we expect on a purchase that you guys are going to help out the client, which helps me to get their lower rate. So when they say, what's the national average? I can guarantee you that rate is done with paying at least a point, if not 2, to get that rate down. A mortgage banker, it's probably going to cost them 2 to get to 6 1/8 or 6 1/4. It's going to cost me 1.
So in theory, it's really the same cost as a traditional banker or anybody else. You're competitive in your rates.
Yes and no, except on this particular, okay, that gets into another piece of this. In other words, what we call borrower paid and lender paid. So every time a loan is done, that mortgage banker, that bank, that broker, being me, okay, has to get paid. I get paid. And here's what I love telling people. You know why everybody out there who's a loan officer should be a broker. You know why they don't want to do it? Because they have to disclose how much money is getting paid to the broker. In other words, the owner of my company, of Barrett. Trevor Barrett's the owner of Barrett. His company gets paid. Then I get my percentage of that, right? And by the way, anyone who does this type of loan or any normal conventional loan, unless it's a super low loan amount, I have fees like everybody else. Every loan officer has the same fees. They have processing fees. They have admin fee, which they can call underwriting fee. They can call it whatever they want. We all have fees. My fees at my company are $1,345. Every client that does a loan with me, FHA, conventional, whatever, this loan, I pay those out of my portion of the commission. They don't pay $1,345. So right off the bat, coming to a guy like me, I choose to pay those. I've always done it for everybody, even people I don't like. All right. So let me tell you what lender paid is and borrower paid. So lender paid means that the actual lender is paying the compensation, whatever that contract was, to the broker or to the mortgage banker or the bank. So typically, I'm literally very proud to say this. I love that I get to share how much compensation is paid to my broker and then split up. Okay. 2% is ridiculously low. Mortgage bankers are usually 3%. And if it's FHA and VA, we're talking up to 4% and 5%. So we are like the discount tires of mortgages.
Lending, that's right.
Okay. Now, how does it work on this one? So if it's not lender paid, then it's borrower paid. So what does that mean? The borrower pays that 2%. Okay. So on this loan, it is a borrower paid. So they are going to be responsible. So if it's a refinance, it's easy. Some of the equity is going to be that 2%. That's how my company has to get paid. That's how I get paid through them. Okay. So it's going to cost them 2%. Now, what's the benefit is there a benefit? Oh, it just cost me 2% of 500,000. That's 10 grand. Really? To save probably 250 in interest
$300,000 over the grand scheme of things.
Yeah, the interest when we get the results on the simulator is going to show not 10,000 or 50,000. It's going to be in the hundreds in most cases. So can I answer a question real quick? I'm giving a question myself. What's the average since this loan started in 2005? What is the average time frame that people pay off their house?
5
to 12 years.
Wow.
Okay.
That's average. Average. Imagine not paying a payment. And by the way, when someone comes to you and they say, hey, I want to do a 15-year loan instead of a 30, guess what? There's a difference in payment. If you're going to shave that much interest off of
Why not
it,
just do everybody a 30?
right? Well, you can't. That's what I tell people. Before I started selling this loan, that's what I used to say. Just do a 30. I'll tell you what the amortization schedule is for that 15-year. And it's usually, let's just say it's $1,500. It could be depending on the mortgage size, right? But let's say it's $1,500 extra. Pay $1,500 extra and it'll pay off in 15 years. But if you have a crisis where your car got in a wreck and you need the cash, guess what? You still have a 30-year loan. So now you have that extra $1,500 to pay it.
That's right.
But on this loan, guess what? It's not the payment doesn't go up because you're paying it off so fast. Don't forget, all your extra residual income is going into this. It's a checking, it's a savings account. And when you need it, you just write a check or use your debit card. You go on a trip, like you said, hey, why not take a trip? I don't want anything in your budget and your lifestyle to change at all. So are you still going to take vacations? I can tell you, here's what happens. When people get this loan, always the simulator comes out and it says, say 9 years. You're going to pay it off in 9. I've never not had a client call me up. Guess what? It's paid off in 7. They get so excited. You know why? Because they get serious about their budget and how they spend, because they see the results every single month when they get their statement.
Right.
Versus a mortgage, a normal mortgage, you see it and you
I've seen no change.
Yeah,
no change.
It's almost all
Equity is
discouraging.
gold. That's like hitting the lottery, you guys.
Right. Thank you.
That's
Yeah.
literally hitting that. If you're looking at your statement every single month and you're seeing those who have seen a mortgage statement, you borrow $300,000, for example. At the end of that 30-year amortization, it's what, Glenn? $900,000, $750,000.
Yeah, you're paying double to triple.
It's 2.5
depending
to
on-
3 times,
Yes.
right? To see it go the other way, again, guys, that's generational wealth.
It's unbelievable.
That's what it's all about.
So, I get a question. Well, why would a bank do this? Why would a company come out with this if they're not making tons of money?
There's only a few that do, right?
It's one.
Only
one.
What is that, Pink?
Okay. Do I really want to share it?
No.
Yes. I don't care. It's called CMG.
Okay.
Okay. They're a broker. Okay. They're in California and they do lend in California as well. By the way, I have licenses through my company. We're in license in every state but New York. And then I can either use them or I have to cost when I use them in other states, except for ones like right now I'm in California and Tennessee. Okay. But I can get licenses in like seconds in any state.
This loan makes sense really for also non-owner occupied with large, like multi-dwellings,
Okay.
right?
It's very similar to conventional. Once you get over 4 units, then it becomes a commercial loan.
Gotcha.
That's a little different. Okay. But that brings up another question. When you do a investment loan, and like you talked about earlier on second homes, I don't know if the listeners heard that and understood that, but on a second home a few years ago, Fannie Mae and Freddie Mac said, I think because the market went up so fast, they got fearful of the risk that if the market turns, what are people going to walk away from? They're going to walk away. Are they going to walk away from the house they live in, their primary home? No, they'll walk away from a second home and an investment home.
That's right.
First. They have the highest risk. Because they have a higher risk, it used to be just a few years ago and all the years before that, if you did a second home, the pricing on a second home was identical to a primary. When I say pricing, that means Fannie Mae and Freddie Mac, they're the only conventional loans out there that back it. They charge a cost. What is that cost? So like as an example, if you're putting 20% down on a second home or investment, you're talking 3.25 points. Every point's 1% of the loan amount. Just as an example, just say it was $1 million loan, just to use easy numbers, right? That's 3.25 points. That's 32,500 in points. If it was a primary, there was none of that. You have zero. Okay. If you put 25%, that goes down to like 2 3/4, 2 5/8. If you put like 40%, it goes down to like 1.8. Okay. So the more you put down, those numbers go down. But on this loan, there is a cost, but it's nowhere close to that. We're talking like 0.5 point for a second home but why not do what I said earlier? Like your family.
You know, it would be cool, Landon.
What's that?
To do a debate. Take Glenn and then take a traditional mortgagor and just kind of come up with a series of questions and do a true debate.
Yeah.
Your response to that, Glenn, your response, ABC Financial Broker.
Glenn says they don't want none, right?
They won't come on the show. Number one, they won't have a clue what I'm talking about. They'll be going, I've never heard of this in my life.
Gotcha.
This is not real. People listen to me. It's not real.
That's good stuff. Well, Glenn, I really appreciate your time, but I've got to say that we've absorbed a lot of information. I think we could definitely do a part 2, possibly part 3, and part 4 of this. But for
this
someone
is just the surface.
Yeah,
right.
We got to
It's
do
true.
this again.
Yeah, I mean, because we haven't even really we mentioned the investment portion, but we haven't really dove into that.
No,
and
there's
so
so much more.
We definitely need to dive into that side of it. But for someone who's watching that's curious, just off hearing what they've heard today, what are the first 2 steps they should take to see if this is actually going to work for them? Because it does seem a little complicated.
I'm glad you said that because it can. I mean, look at all we've talked about. We've been talking for over an hour, right?
Yeah.
And this went so smooth. It was easy to talk about because I see the passion. I love sharing something and seeing your guys' eyes go, I love this.
Yeah.
From the first time I talked to you, that's what I heard over the phone. And now we get to do it in person. Okay. I'm going to do the same thing on a Zoom call. So if you really want to know what this could potentially do for you, it's not for everybody. And I'll be very candid and upfront. I won't be rude, oh, this isn't for you. Come on. No, I'm going to tell you how to make it for you. It might be a year, it might be 5 years down the road, but this is a loan that everybody could fit into, right? It really, at some point. Now, you may have to change your income. Dave Ramsey always says, how do you get rid of a debt faster and get another job? You might have to do that. But why wouldn't you if it's creating a legacy for you and security for you and your spouse and your children, right?
Absolutely.
This is not as complicated as you think. It really isn't. Once you get it, like I want to share just a quick story. I had a client, this is somebody I know from my church, and they came to me. He's 70 years old, him and his wife, and he said, hey, I have to work probably another 5 years because we want to get a 15-year loan and pay that off so we have zero debt going into our retirement. And I said, okay, tell you what, 15-year loan versus a 30, you're going to pay more. Well, I can afford it. I make really good income, and he does. He makes excellent income. He's in the great category for a W-2 employee. Okay. I said, okay, but would you please open your mind? I know you've had a traditional loan forever to look at this side by side. So I did. Because kind of going back to that self-employed guy who usually gets it on first round, second round, or third round, it took me 6 times showing them till the husband got a little faster. The wife was after we closed. And you know what? I saw him at church and he's like, unbelievable. We are like getting so excited because this loan's going to pay off in 1.6 years.
Holy.
It just changed their life. This
And he
is
was
game
looking at
changing.
15 years.
Okay. And he was going to do 15 and he doesn't have the payment of a 15, but he's just putting it in. He goes, I didn't understand. They were actually driving back east to go visit their kids. And I called him like 2 weeks after because here's a process. When you close on this, they have to set up the checking and the savings and all that into this mortgage. Okay. Gets bought by a bank and their whole system and their software gets built into this mortgage. Doesn't happen overnight. Takes about a month. Well, at 3 weeks, he's like, okay, Glenn, we're driving back east to see our kids and we just got this. And I go, okay, have you moved any money in? He goes, we were afraid to do it. I go, what do you mean?
That's the whole point.
They didn't get it. They still didn't get it.
Take some money. If you got liquid underneath the mattress, put it in there.
That's exactly what I said. How much money? Oh, I don't know. I said, come on. I already know all your finances.
Right.
Tell me. It was like 100 and something thousand. I go, put that in today. Well, what if we need it? Okay. You still didn't get it.
Got it.
You didn't get it. You can borrow from it anytime you want with zero cost. Zero. Did you hear that? Zero.
You should think of this also for the viewers like a bank account, a savings account.
It is.
A wealth building account.
Mm-hmm.
So you know how many people go to ING or other places where they right now can get like, it was 5.5% and it's down now to like 4.5%. Does that sound good on your money? It's guaranteed.
Yep.
Sounds great. Get a CD through your savings account. Guaranteed. Remember reverse investing? If it's 8%, you're guaranteed you're going to get 8 off. Yeah. This will blow that away all day long.
This is nothing more than a mindset, really.
It is.
And for those that are listening that are friends of ours, because there is a reason for the traditional mortgages as well with our FHA and some of our other clients. There just is. That's why there's so many tools to use a professional to help guide you into these different tools. But if you change your mindset rather than the culty types of shove it down your throat of this is traditional, this is what your neighbor's doing, this is what the guy did 30 years ago, this is what your parents did, this is what everybody's doing, this is what the masses are doing. Just change your mindset. Really what it comes down to. We gotta move and change. We gotta just move with the times and change and be more flexible. Just have an open mind when it comes to building wealth and to buying real estate. Glenn, thank you.
And it is game changing. You want a game changer in your life that'll take your finances to another level, take the pressure and stress off of every single month as you're building equity. It literally relieves stress. Life is a challenge. every day.
Give this guy a commercial real quick and his phone number and his email address and how to contact him. That would
Yeah.
be fantastic.
Glenn, how can our listeners get in contact with you when they want to learn more about this game-changing loan, the all-in-one loan?
Thank you. Yeah, my number, you can contact me. This is direct, 602-469-8694. 602-469-8694. And you can email me. And by the way, sometimes that email doesn't come through, which we found out.
Yeah, that's
they were
right.
trying to get a hold of me. So that would be the best way if you want to try to send an email. But because I am in the lending business, we really we get a lot of phishing. People trying to steal
Sure.
information from us, and because of that, we are on high security. A lot of emails don't come through. So you may put in all-in-one loan or game-changing loan or contact me. They think that's phishing, so it may
Okay.
not come. But
Just call.
You can call is the best. You can try Glenn. It's GLENN, 2 N's, at barrettfinancial.com. Barrett's B as in boy, ARRETT, financial.com. You can try that, but call me. That's the best way.
Thanks, Glenn. Thanks, Martin,
Yeah,
as
you bet.
always.
Thank
And
you, guys.
thank you guys for tuning in. Have a wonderful day and happy Thanksgiving to you and your families.